Theme parks have had a rocky year as they look to bounce back from the lows of COVID-19. And our next guest says estimates need to come down to better reflect the challenges ahead. Citi Research Director James Hardiman joins us now. James, good to see you again. We're right in the middle of Fright Fest for Six Flags, and it's been a very frightful year for that company. They have really been struggling. How do you think this quarter shaped up?
Yeah, I mean, and you're right. It has been a tough year for these guys. They had a new strategy where they're essentially aiming to have fewer customers, right? Well, the strategy that we
No, that's not a good strategy. Here, please, we don't want to let you in. Take less business. We're okay with that.
That's right. It's what we dub the Jerry Maguire strategy, right? Fewer customers, more profits, better service. That may have made more sense coming into this year. I think it's been a tough sell as some of these macro pressures have mounted. And so to answer your question, I do think it was a tough third quarter for these guys. I think estimates probably are too high. And I think attendance, if anything, it was pretty bad in the second quarter. If anything, there's a good chance that got worse here in 3Q.
James, for the lay person following this Six Flags story, and the CEO made some just bizarre comments on that last earnings call, but push that aside. What is wrong with Six Flags? Is it the stands where they get the food? Are the rides not cool enough? Is it a combination of all that? Or is it just too expensive to go to these parks?
Yeah, I think it's a combination of all of those things. Relative to other theme parks, Six Flags has historically not been able to get the pricing that those others have and that they would hope to, particularly since they cater to some of the biggest cities in the U.S. with some of the best disposable income. It tends to be a lot more teenager oriented as opposed to family oriented, and I think that plays a role in terms of the pricing that they're able to get. There's an argument to be made that they haven't invested enough in their parks over the years. And that has also led to this sort of lower quality experience, at least that being the perception. And so I think that's all what predated this new concept that they ultimately had. They didn't put it this way, but that they fired their customers in a lot of ways. And you got to be real careful with that, suffice it to say.
That's bad news for the Dippin' Dot barometer, James. When we think about some of the other major theme parks that are out there, I mean, what is going to be vastly different between this year and next year? This was supposed to be that travel demand boom year, that revenge experiential economy year. If not this year, then what does that shape up for next year for the theme parks?
Yeah, it's such a great point. I mean, we were believers that there was this pent-up demand as we exited the pandemic for exactly these types of experiences. Unfortunately, there isn't a whole lot of daylight between the post-pandemic phase or story and the pre-recession or recession story. And I think those two things ultimately butted up against each other here in the summer of 22. I've got numbers lower for next year. We have seen pretty consistently over the course of the summer slowing demand trends for the theme parks. Now, the good news is I do think that these companies, these businesses tend to hold in better better than some of the other discretionary names that I follow, right? And so they're going to feel it. I think attendance is likely to be down. Sales are likely to be down. But they generally hold in pretty well. And the reason for that is they tend to be trade down beneficiaries, right? As opposed to, once travel turns over, if in fact it does, these tend to be cheaper alternatives than going to, Orlando or Mexico or Europe.
James, what you often see in a lot of these theme park parking lots is Winnebagos. Family take these Winnebagos and they go to the theme parks. Now, that is a stock you cover. This company just reported earnings. Take us through their inventory situation. Are they able to get the semiconductors and the supplies they need to get these trucks or these mobile homes out of the showrooms and into the front porches or the driveways of customers?
Yeah, I mean, so that was the narrative for so much of 2021 and the early part of 2022. Could they get the supply out there? Because there was very much the belief that true demand was better than these reported retail numbers, i.e. if you had more product, you could sell more product. I think that narrative has changed over the past 3 months. And oh, by the way, I don't think it's just for RVs. I think the ability to stock showroom floors has improved dramatically. And if you want to get one of these, you can get one of these right now. I think that it's a double-edged sword now, though. The concern is that these manufacturers will pump up the channel too much with some of these inventories. And that would ultimately make a bad situation worse as we think about a potential recession. And again, it's not just RVs. I think this whole debate as to are we or aren't we heading towards a recession, in what I cover, right? Big ticket discretionary. In a lot of ways, it feels like we're there or quickly approaching that place. It does seem like over the past few months, supply has improved, but the demand has not.
All right. Well, for those of us, Brian and myself included, who are priced out of the housing market, the RVs are looking pretty good right now.
Sign me up, baby.
Citi Research Director James Hardiman, thanks for taking the time here today. Have a great weekend.